When it comes to trying to create a portfolio of covered calls, what should we screen for? We're going to talk a little bit about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Many of you may know, and maybe a few may not, that I recently joined up with some of the folks over at Title Financial Group as the YieldMax strategist. YieldMax is a company that runs several actively managed options-based strategies that focus, as the name implies, on maximizing yield. And the way they accomplish that is by choosing stocks and selling options premium around those stocks. Some of these are just single stock covered call ETFs. You buy a stock, you sell a short dated upside call, and rinse and repeat. Some of these funds take a bearish position on those same stocks and do overwriting strategies that way. So, for example, there's a bullish strategy on Tesla. There's a bearish one on Tesla. There's a bullish one on Strategy, formerly known as MicroStrategy, and there's a bearish one. There are other funds, though, that use a diversified portfolio of stocks. Those might be, large cap equities, which are predetermined. So Biggie, for example, just takes the 50 largest publicly traded companies and sells options premium on those. Others are sector-based. So there's a semiconductor one. There's one that's based on cryptocurrency. But there's also a fund that is called ULTY, and a question that I got in Monday's comment section was, well, maybe we can pull it up or we can just see what it says. It wasn't particularly enthusiastic about the selection of stocks that the managers, in the case of ULTY, had selected for options overwriting. Now, ULTY, it should be said, is not simply a buy-right fund. They actually collar the underpinning position, so they are selling some upside calls, they're buying some downside puts. They're trying to do that in a way where they're ensuring that they are, on balance, collecting premium. So the idea is that you're still collecting premium. But as far as the stock selection process is concerned, and this is what's going to, something for us to discuss today, what are the criteria that one should use or think about when it comes to building a portfolio yourself and saying, okay, these are stocks that I would consider selling premium on and that I would either want to be long or want to be short. So to do that, I thought we might just go through different screening criteria one could look at and which ones seem to work, and see whether we can't construct something that might look a little bit like that. So I've got my screen up here. I'm using a function in Bloomberg. I'm sure there's a lot of different screening tools. Some of you may have access to them. But a lot of the things that we're going to be looking at aren't, this is no deep magic, really, so to say. So what we have here are a series of technical screening things. We've got recent returns for the equities. We have some valuation metrics we can choose. And when you look at the way Bloomberg's screening tool set up in this particular instance, now they have more complex screening tools, but this is a fairly easy one. So you'll notice in the upper left-hand corner here, I'm just going to make a little indication right up here. The universe we're going to be looking at for this exercise today is the Russell 1000 index. So it's effectively the largest 1,000 companies by market capitalization. Now, when you're looking at these little color bars and this higher or lower, so we'll just draw this in here too as well. So what this is saying right over here is these are the factors that worked. Okay, so how strong is that factor? That's going to be up here. And, what the number is that you're hoping to see. Now, and down here, this is the number that we have, basically the average for the entire index. So we'll just go through this first example. In this case, the factor we're going to look at is the 1 month total return for the underlying stock. So we can see from this color bar here that this is a factor that has done very well. It should probably come as a surprise to nobody that this is a number that you want to see higher. In other words, if the total returns for the underpinning equity were positive in the past month, that is better than if they were negative. And this makes some sense because what we're really trying to figure out in this particular instance, this is kind of a momentum indicator, right? So if the stock is higher over the last month, that's probably an indication that the momentum is on your side. You'll also notice, for example, there you will sometimes see things that you would think, you might think the opposite, right? So let me give you an example. Here, for example, on the dividend yield section, you're going to notice that the returns have actually been better if the dividend yield was lower. And this kind of goes against how some value investors might think about it, but there might be a rational intuition for this. What could that potentially be? Well, generally speaking, faster growing companies are less likely to pay dividends, right? Companies that trade at higher multiples are likely to have lower dividend yields, if any dividend yield at all. And that might not sound like a positive necessarily, but when you're looking at relative performance, what are the stocks that typically perform the best? Well, we can just take a quick peek and say, all right, well, why don't we just take a look at this universe and say, all right, well, which ones are the stocks that have done best so far this year? Now that's year-to-date total return. So last trading day of December of 2024 through the present. And we can see the kinds of companies that have had the best year-to-date total returns. And a lot of these are the kinds of companies that are not likely to be paying big dividends, right? So now why don't we just take a look over at valuation and see whether some of the things that we would normally think of if I was building a portfolio of value stocks or growth at a reasonable price stocks with the intent to hold them for a very long period of time, that's one thing. If I am, on the other hand, looking for stocks that I have a feeling are likely to perform well in the short term, that might be something else. So if we go over to valuation, you're going to see a little bit of a carry-on to what I was just discussing. So once again, one would think that you would be better off buying stocks with lower PE ratios rather than higher ones. Except that the higher PE ratio companies are very likely the fastest growing, and oftentimes in a bull market, they're the most rapidly appreciating. So it kind of depends whether your intent is to take a Warren Buffett approach, that you intend to buy some companies and hold them forever, or whether you're trying to trade some momentum. And the reason I bring this up is because the ULTY fund, for example, is looking, number one, to capitalize on momentum, and number two, because it's an options-based strategy, it will tend to turn over the portfolio a little bit more frequently. Now, that's not to say that you can't come up with growth at a reasonable price companies and just say, I'm only going to do call overwriting or cash-covered put sales or things like that on those stocks. But it is also true that when it comes to option strategies, that sometimes the interesting trade or the most attractive one isn't necessarily a long-term investment strategy. And the example that I'll just provide, and I'll do this in a separate window, is some of the things, for example, that Carter Worth has done with his strangle sales, where he often looks for circumstances where news has come out about a company, the company has moved sharply, perhaps implied volatility, perhaps the price of options has not declined as much as one would normally expect coming out of a catalyst, and the reason for that might indeed be that because the news was unexpected and the stock gapped sharply, that the stock ended up seeing somewhat elevated volatility. We'll just walk through a couple examples of companies that he has looked at recently, that I've also looked at recently, that we've maybe discussed here. But Meta is an example. Higher than expected CapEx. I'm just going to shorten this up because I don't think we need to look at a really long time frame here. Higher than expected CapEx looks to sell a strangle around that stock because the news has come out and volatility rose a bit. DoorDash. This was another example. News came out, stock gapped lower, elevated options premium, sell a strangle. I think Oracle was another example where the stock had gapped up. He thought the run it was a bit too much, so it had run up, it had come back, and then I believe he looked to sell a strangle, but the strangle was relatively short dated. Something like this, if my memory serves. And a lot of those trades that he was doing were of a very short-term nature. We're talking about 2 to 3 weeks. You can see that since that time, this one has given back essentially all of its gains. But for that period of time, it kind of, that trade worked out pretty nicely. So going back to our screening then, and understanding that in a short premium context, sometimes you're not really looking that far out. So the valuations might be a little bit less important. But what you can do is you can begin to put some filters in and say, okay, well, if a higher number here is good and a lower number there is good, then you can start to put that in and you begin to chisel away until you find some stocks. Now, what's interesting is that if we do that, the PE ratio being higher, that's just basically the idea that you're dealing with companies that have somewhat better growth. So we'll just choose higher than, so the investable universe average has a multiple of 22. We know that the market, I think, is closer to 24, 25. So I'm just going to take a look at companies that are greater than 22. This isn't a great factor, but it's just sort of a way to get started. Now, the next column over, this is something that probably makes a lot of intuitive sense. And that is that the lower the forward price to earnings growth ratio is, the better off you are. That's this number here. So in other words, we don't mind if the PE is high as long as the growth is also high. And the PEG ratio simply takes the PE and it divides it by the growth. So 4.2 actually for a PEG ratio is not particularly low, it should be said. So I'm actually going to go for a number that's a little bit smaller even than the refined universe of stocks. But let's just take a look in here and see what that leaves us with. So now we're down to 172 stocks. I'm going to kind of ignore this div yield. And this is just basically because I know that a lot of you who have been watching this for some time will know that for me it's very difficult to choose companies that I think are dubiously priced. So I'm just going to sort of set a little bit of guardrails in place for that. So let's go take a look at the momentum issues now, which we can do via the technicals. Now, if we take a look here, and I may not actually use this in this particular instance. This is the 14-day relative strength. You'll notice, and this might also be counterintuitive, that this is actually better if it's higher. RSI is sometimes used as a contrary indicator. That is to say that, and actually let's come up with an example I'll do that right now. Strategy's just been in a long-term downtrend. Why don't we look at, we'll just look at Alphabet. We'll look at Google for a second. So the relative strength indicator, that is down here at the bottom. And some people like to use this as a contrarian indicator, saying that if the RSI gets to a high level, that the stock is overbought. And if it gets down to a low level, that it is oversold. And they use that as a technical indicator for short-term trading. Couple things I would point out about this. The first is, I wouldn't necessarily suggest that this moment in time proved to be, this is when the RSI actually got to that lower bound, that proved to be such a great time to buy the stock. In fact, it actually went a bit lower. And I think I would also suggest that right here, which is about when the RSI first started to get quite elevated, that this would have proved to be such a bad time to buy the stock, because we can see what it has done in the meantime since. So in terms of momentum, it's clear that hasn't worked so hot, and that is indeed supported by this over here. So this is basically looking at the entire universe of stocks and saying, if these barometers, in what way were they related to the subsequent performance in that underlying stock. So it turns out that RSI is not so great. A higher number is actually better. The next one, these two probably do make a little bit more sense. This is the 50-day and the 200-day. Let's go back to our chart here. All right? And let's make this a little bit longer. And I'm just going to... Folks will know, by the way, that on CNBC, and particularly when we have Carter on the show, we very often use the 150-day as a long-term moving average. What is a moving average? It's basically a trend line, right? So are you going to use 50 days? Are you going to use, for something like crypto, people have recently been using really long-term moving averages, like the 50-week moving average. But in general, the point of this exercise is to say, is the stock essentially holding up above its long-term trend? You're just auto-drawing a trend line. We have drawn a trend line here, and is it above that number? And obviously the 50-day is going to be a somewhat shorter day. Now, it does appear that the 50-day might have been I'm not going to do a back test on this right now, but it does appear that the 50-day moving average, as entry and exit points, might not have been terrible. We can kind of see that here, right? So you would have sold it here, but then you would have bought it almost right back, and you would have held it until here. You actually still would hold it, and you would have sold it here. All right, so your entry point here, exit point there, not bad. Here you would have been probably chopped up a little bit because it was going back and forth, but if you're waiting for some confirmation, give it a couple days, that kind of thing. So again, this is not a hard and fast rule that you can just simply say, okay, it's above the 50, it's a buy, it's below the 50, it is not. But what we do have is some evidence, in the form of all of these stocks at least, that you're better off if the stock is above the 50-day moving average. So we'll put that in as a threshold. And if it's above the 200-day, that too. And as we do this, one of the things that starts to happen is we're starting to get down to an ever smaller number of companies, right? So far, so good. Now, one of the things you're going to notice, probably as we go through this, there's a couple all-stars that appear on this list. I mean, maybe I should just put this into an alphabetical list. I could do that. But, am I going to do that? Let's see here. Let's go back here. We'll just do that. Maybe if I put it in an alphabetical order, it's just going to be a whole lot easier for folks to sort of recognize. So we've got our universe of 73 stocks, about 7% of the Russell, and take a look at some of the companies that we're finding in here. There's a couple that are really no big surprise at all. Alphabet, right up here. We have Cboe, the exchanges have been doing fine, of course. Caterpillar recently, but Broadcom, not a big surprise there. And we're definitely going to find NVIDIA in here. I'm going to scroll down to that. There it is. We saw AMD, I'm pretty sure, in here. There it is, right at the top. I just went right past it. So this creates for us a suitable starting point. And now the next sort of phase of this whole exercise, and I could pare this down by saying, okay, well, I want to look at other valuation metrics, or I want to look at estimates, for example. Now, this is actually kind of an interesting one. This is something that I generally do myself when I'm screening, and this is sort of a process I go through fairly regularly. People who watch, I say it again and again, but things that I care a lot about are things like revenue growth, EPS growth. So, you can find things like that in here. Now, what are we looking at here? This actually is the forward EPS. Is that number going higher? So this really has to do with whether or not the sell side, the analysts, the people who cover it, are raising their estimates for growth. So that's something I like to look at. So I want to see growth on the top line. I like to see growth on the bottom line. I also like to see that, what people are looking at, that their estimates for growth in the near term are actually going up. Caterpillar, by the way, people who are paying attention, those who, why don't we just go ahead and do that? Let's see if this, hopefully this doesn't make this list too short, but we'll put it in anyway. No, it's not bad at all. So that gives us 61 stocks we're down to now. Okay. So now we kind of have a starting point for stocks that we like. Now, remember, we could do the same thing in reverse if we were looking for overwriting strategies on the bear side. And you can do that a couple different ways. You can sell call spreads, for example. That's a neutral to bearish strategy that's looking to collect some premium. But, from a directional point of view, we've kind of lined things up. We can see up here, and look, people can always pause the video or do whatever if they want to. And maybe I'll just do that. Maybe I'll just sort of scroll through this very slowly so people can get a sense of it. This is the first 15 stocks, starting with Aon going through Clearway. And we have a few more in here. I'll just leave it up here so people have an opportunity. Go past Insulet. Just in case you guys have an interest in looking at these yourselves. I mean, like I say, you can always hit the pause button and see what's there. And here we can see the rest of what is beyond below Roku. Okay, so having done this, the next exercise is, well, does it make sense to sell premium on these stocks? And for me, I think I've said more than once that if you're going to sell some premium, you're going to be foregoing some of the potential upside if you're doing something like a buy right. But I still expect to get returns, risk-adjusted rates of return that are commensurate with the kind of risk one would typically associate with equities. Now, that's a broad way to describe it because the risk of investing in something like Alphabet is not the same as the risk of investing in companies that are much more cyclical in nature, that have much more balance sheet leverage, that might be more speculatively priced, that sort of thing. But so we're going to try to look at that a little bit in turn as well. But having done this, let's see, did I get my list to populate? So what do we have here? Okay, good. All right, so now we have a list of stocks to begin with. All right. So what do these stocks have that we like so far? All right. These are stocks that analysts' estimates for EPS growth have been rising, that have reasonably attractive PEG ratios, price earnings to growth, are above their 50 and 200-day moving averages. One of these, as we can see down here, is actually a stock that I mentioned on Monday. You might not have caught it when I did, but I just caught it out of the corner of my eye and said, that's a name I mentioned, but I might not have gone into it at all. What was the context if anybody was watching on Monday and said, well, I don't remember him talking about Howmet? I mentioned it simply in passing, along with Safran and MTU, as component makers for the GE CF6 engines that were powering that MD-11. So Howmet Aerospace is known to also make components in those engines. Now, whether they actually made any of the components in the engines that were actually on that plane, I don't know. Are any of the manufacturers to blame for what happened? I don't know. I'm not trying to speculate on that. But I did mention it. Okay. Next step. We want to know how much the options cost on these stocks. And the higher the implied volatility is, then the higher the options premiums one would expect to collect. Now, I do not, for myself, I don't do 1 week buy rights in, for example, my own account. Generally speaking, when I have looked at short options trades, I like to go a little bit further out in time. The reason I like to go further out in time is because I don't want to have a whole lot of gamma. And that's, what is gamma? Gamma is essentially the convexity. It is the rate of change in the rate of change of the options price relative to changes in the price of the underlying asset. But a simpler way to think of it from my perspective is this, which is that short-dated options might decay rapidly as a percentage of their own value, but their value relative to the price of the underlying asset can be quite small. And because of that, you're basically picking up small amounts of money, frequently, but you're picking up small amounts of money, and if you get something wrong, the amount of offset that provides isn't so great. So I like to stretch it out a little bit further. Many will know that I've said on more than one occasion, I'm not enamored necessarily of selling options through a catalyst such as earnings, because it's less clear from the research that there's a persistent volatility risk premium. So let's take a look at that then. We're going to put that into the mix. And in so doing, does that say equity on it? It does, okay. Oh, by the way, I think I remember what the field is for this, and let's see if I got it right. I did, okay. And we'll put in today's date. And actually, I'm just looking for days here, so I'm just going to... All I'm trying to do right now is just make sure that if we start selling some premium, we're not going to be selling it directly into earnings. We've got one. We've got, obviously, NVIDIA is coming up. So let's just say, for the sake of argument, that I want to sell options, and I'm looking for options that expire at least 45 days away. So that means I do not want anything that is less than 45 days. So we're just going to say, actually, you know what? Before I do that, let's go take a look at an expiration. This probably makes more sense. And we'll take a look at the calendar. And let's just head on out to, well, December 26th. I guess we could do that as year end. So that's 44 days away. Yep. So we don't want anything that is, I'm just going to eliminate, well, actually, let's see what falls in. Before I do that, let's just quickly see what falls inside of this, what names do report. We've got Ciena, Broadcom, Marvell, NVIDIA, Keysight, and Ferguson. Okay, so that's not to say that there aren't trades to be done in here, but for this exercise, these all are going to get eliminated, so I'm going to select everything here, and then I'm just going to get rid of these. The longer earnings dates don't matter that much because I'm not going to go that far out in time. But at least we're going to eliminate earnings as a potential catalyst. Okay, so the next step then is, what does the, how much implied volatility do we have? And this is going to give us a sense of how much we can expect to collect in terms of options premium. So, okay, why don't we look at, we'll look at 60-day implied vol. And why don't we go, let's look at 105% moneyness. So what is the implied vol of a 5% out of the money call? I think that's probably a good place for us to start. All right. Here we are. And it's, we don't need to get down to hundredths of a percent, which is what this is. In fact, we don't even really need to get down to tenths of a percent because that's not where we're going to execute it. So these are percentage numbers. There's a really low number in there that just stuck out to me. Let's take a look at what the implications for this are. That doesn't seem right. Well, we'll take a look at that in a second. Well, let's see how this impacts the amount of money that you would expect to collect for an option that you would sell. I think looking at Yum Brands, which is kind of an interesting one to look at because it's a, we're dealing with a discretionary. So what are we looking at? I should probably bring up options play at the same time. Let's do that. And we'll look at an example here. If it doesn't take too long. All right, here we are. So if we, like I said, I was looking at 60-day options, so we'll look at something basically like that. So here's, we buy 100 shares of stock. We are going to look to sell a call. In my example, I was looking approximately 5% out of the money, so we're really going to be looking at, they don't have a 157.5, so it's going to be, it's either the 150s or the 160s. All right. Now we can begin to see what the problem is when the implied vol is fairly low, right? So we didn't happen to have an exactly 5% out of the money strike, but what we do have is, the 160s. I'm just going to say the stock's 150. So we're looking at selling a call that's 6.7% out of the money, and you're going to collect 93 cents. That's at the mid price against 150 stock, just to keep the math easy. That's 62 basis points over the course of 37 calendar days. So that works out to a not uber compelling annualized rate of return, incremental. So that's really what I'm talking about, is how much incremental return am I going to collect for selling that call? That's not terrible. If you collected 62 basis points on your stock every 37 days, you're getting an additional 6% out of it. So you could say to yourself, would I be happier with Yum if it paid a 6% dividend than I am with that one? Well, yes, but you're giving away any of the potential upside. And I can kind of see something like this chopping around. So to me, that is not quite there. Folks who have watched this channel before will know that generally speaking, what I am looking for is something akin to an annual rate of return that is commensurate with the risk associated with owning equities, because I'm taking equity risk to put on this trade, and I'm giving off some of the equity benefit by selling off the upside. I'm really looking for probably a minimum of 10 to 12%. So based on that, going back to our earlier screening approach, what we can see is that something that's got a 20 handle, that's probably not going to work. So we're going to just bump this up, and I'm just going to say, okay, well, it's got to be closer to 30 then, right? And we can see that this list is now shortening up quite considerably. And, well, we can look at maybe at XPO here. This is not a name I think I've discussed, and maybe we can walk through an example here and see what we get. And then we're going to go back to the terminal, so we have a sense of some of these other, the other financial elements that we're talking about. All right, so 37 days. This one does not, does it? Does not. This one doesn't happen to have weeklies, so I can't go out to those DEES 26, which were over 40 days. But I can go out to the DEES regulars here. I want to capture at least some potential upside. So we've got $140 stock. Maybe I'm looking to sell the one. Let's see what strikes we have. Probably the 150s. There we go. All right. So now I've got the 150s versus 140 stock. So that means I've got more than 7% of potential capital appreciation in 37 days. And I'm collecting, I'll round down, $2.75 a contract over 140. I'm now getting almost 2% of the current stock price in 37 days, which works out to 19% of incremental yield. So I've got 7% potential capital appreciation, and I have an incremental 19% annualized in yield. Does $2.78 create meaningful downside protection? Oops, sorry. What is that? Okay. That was Teams. That was Teams. So we're now getting into the realm of something that looks a little bit more attractive. Well, let's take a look now at something where the volatility is really high and where there are 40-plus day weeklies and see what it begins to look like then. All right, so we had already set the threshold here. I think I was, above 30. Let's bump this up even more. Now we've got a relatively short list of stocks to look at. SoFi, there's a fairly sexy stock. So we'll take a look at SoFi. And we're going to go through the same exercise, and then we'll take a look at some of and then I'm going to get to your questions as well. But, all right, so we're going to modify this one. We're going to sell a call. Arguably, this time I want to get a little bit more potential upside out of it. I know this thing has a potential to really move around. Actually, you know what we should do as a part of this exercise is now, because we know we're getting closer to something that we're interested in taking a look at, now is not a bad time to look at the chart and see whether there's anything going on where we think we might. There isn't, as it happens. There's not an obvious level of potential resistance for us to see here because we're trading at all-time highs. Give ourselves arguably, 10+% worth of upside. Let's see what we can do. We've got 32, takes me to 35. Let's go to the 36s now. All right. So now I've got a solid 10+% worth of upside, and I'm getting $1.61 out of it. So that's 5% in 44 days, which is 41.5% annualized. So I have 10% upside plus another 5%. So now we're getting into the realm where is 5%, one of the things I hear people talk about with covered calls is they'll say, oh, it's They make it sound like it's win-win-win. You have upside in the stock. Well, you have some. You get income in the form of premium you collect. Well, yes, you also get some. And then you'll hear that people say, and the income you receive provides some bit of a hedge against a downside move. Well, yes, some. And this is where the really short-dated covered calls tend not really to be that helpful if you experience a short-term move. But in this case, it is not inconsequential. Let's think about two scenarios, right? If this stock goes up 10%, you will make 15% at expiration, because you're going to make the 10% in the stock and you're going to collect 5% in the covered call. If it goes down 10% in the next 6 weeks or so, you're going to lose 5%, because you lost 10% in the stock, but you made 5% in the short call. So in this context, we're now getting into the realm where this starts to make a difference. People who tuned in for that episode where I talked about a long-dated covered call in MicroStrategy, and I was comparing that to short-dated ones, one of the things that I pointed out was that even when strategy was higher, and actually I wonder if I can find that particular slide, because I thought that was, but I would need to update it. It was really quite interesting, because that really was almost a hat trick. You reduce the volatility, you reduce the worst case drawdown, and you had significantly higher year-to-date returns. That was looking at strategy, purchased at 300, sold the 360 calls, and because the implied vol was so high, you actually got real money for it. So it created a meaningful downside hedge. Now, the flip side of that is that there's a relatively small universe of stocks where you're going to find that something like that becomes compelling. But they're there, and some of these are stocks that you might already hold or you already are interested in that are very, this is not some company that nobody's ever heard of. This is a very actively traded, highly liquid stock that sort of ticks all of these boxes. And so this is how I kind of think about the way one would go about constructing a portfolio like that. So going back to the questioner who was saying, well, this portfolio stocks at alt, not every trader, not every portfolio manager is going to take exactly the same approach to how they screen for stocks, what they think is attractive. Obviously, I do a bit more work because there's other things that I like to look at. I like to look at things like enterprise value volatility relative to equity volatility. That is to say, I'm very interested to know if a company has a tremendous amount of leverage on their balance sheet, what how well is that being characterized in the risk of the options on the equity. Now, in SoFi's case, we're dealing with a company that, because of the nature of their business, there isn't an enterprise value for us to look at. You don't look at the enterprise value of banks and financials. Instead, in that case, I tend to like to look at the size of their balance sheet relative to their market capitalization. Part of the reason for this is that if you can imagine, when financials have really gone sideways, when things really worked out badly at a financial, whether that's Bear Stearns or Lehman Brothers or Silicon Valley or Signature New York and all that, almost always, and there can be other circumstances too, but almost always it is because the total value of the assets on the, and the funny thing is people think about, people always, when you think about your own concerns, usually your own concerns are related to your liabilities. What are your liabilities? It's credit card payments at the end of the month, your utilities, your car payments, your mortgage payment. It's basically the stuff that you owe. But when you think about a bank, actually, when I am deciding whether I think it's a good situation or a bad one, I'm always thinking about their quote assets. Because if they misprice their assets, that is entirely the difference between survival and failure. You misprice your assets, or you take excess risk in your assets. That could be, for example, in the case of Bank of America, deciding that they're going to have too much duration in their held-to-maturity book. you're looking at the held to maturity book, they're just amortizing these things over time. You're not going to see it as losses per se. But if you buy, $100 billion worth of assets that are high duration and rates rise in your face and they go down 30%, that's $30 billion that's gone. And in a situation like that, Bank of America is too big to fail, a money center bank, they can always go to the Fed, use these things as collateral. But the problem is, if you have, you've got all these assets and you turn them in as collateral and those assets are paying you very little and you have to pay more to borrow it, then that's just not a great business to be in. So in a financials case, and in this case, you can see the market capitalization relative to the size of the balance sheet is not insane. So, we can see the book value of equity, but, really the issue here is, I'm curious, okay, you get things like this wrong. You get the loans wrong. You get the assets wrong. How wrong do you have to be before you find yourself into real trouble as a percentage of the equity of the business? And to me, that's going to make a difference. But in any case, I think this is a way that people should approach it. This is the way that I approach it. It's far be it from me to come in from the side at the last minute for those who are wondering about what's happening with ULTY. I am now participating with the ULTY Investment Committee. My first participation in that was yesterday. We have another meeting on Friday. And, these are educated and intelligent traders and investors who've been at this for a long time. Their approach might be slightly different into how they select their stocks, but I think now you can see how I would go about selecting them for yourselves. So just something to think about. Okay. Dorothy McCurdy says, if it should happen that the courts say the Trump tariffs aren't legal, how will the market take this? It's a good question. I would say let's talk about the bad part first. The bad part is that there are some things that we do want to have happen, and that it's awfully difficult for Washington to do. So if we have a trading partner that, like China, where we avail ourselves of the products they make greatly, but they are not always a trading partner that's acting in the best interest, nor should they be expected to, of the United States. Is it advisable for us to take steps to encourage national security, to encourage things that basically help prevent dumping, to discourage poisons from coming into the country? If the fentanyl that's coming into the country, which is obviously a national catastrophe, if that's being manufactured in China, we don't want it here. Okay, I think this is something we can all agree on. Unless you're a fentanyl dealer or a fentanyl user, we don't want it. It's pretty straightforward stuff. And we have not really, as evidence, I would suggest, as evidence that Congress isn't necessarily the best equipped to handle this problem. This is a problem that has grown in scale and scope for a long time, and little has been done to rectify it. So does that mean it has to be done by the executive branch? Well, I don't know. What I do know is that with years to work on the problem, the prior approaches were ineffective. I think that's incontrovertible. These are facts that are not in dispute. So to the extent that a part of this negotiation was to something that I think we can all accept as a positive, the market's not going to absorb it as good news if those things are reversed. I mean, whether you hate the president or love the president, the administration, or anyone in it, there certainly are some things that are a part of this process that everybody agrees on, and that the government did not resolve sufficiently, if at all, in the weeks, months, and years before all of this. Now, I'm not even 100% confident that this would resolve it, but at the very least, they're talking about it and they're making agreements. And by the way, those agreements do suggest some culpability, right? If Xi's government is saying, okay, fine, we will do something about the fentanyl. We will reduce it. We will enforce it here. We will make sure it doesn't go there. We are going to take some ownership of this. They are admitting some culpability, and that also suggests that these negotiations have some effect. At least they have enough effect that leaders of two of the largest and most powerful nations on earth are at least paying lip service to trying to solve them, which wasn't happening before. So that's not a positive. The revenues, which the government quite desperately needs, that situation only gets worse. Now, I'm not saying that tariffs are going to balance the budget. They're not. They're not going to come close to it. But they have helped a bit. It's unfortunate that we're at a point now. We actually had a surplus several months ago of about $50 billion, when the forecast, I think, was for something like a $15 billion deficit that month. It just has to do a lot of times with timing of payments and revenue receipts. That wouldn't have been a disastrous month from a federal budget perspective in any case. But the fact is that a $60 billion per month difference is really quite material. It used to be material. I mean, that's $720 billion a year. That's 10% of the federal budget. So something like that should matter. So that would not be a positive, I don't think. We want more onshoring if and when and where we can get it, and we would like to see that we have at least some control or better control of critical resources like rare earth. So I don't think that would be a positive. On the other hand, it has been disruptive to some businesses. Now, first, I don't know how many of you are aware of this, but First Brands is an Ohio-based auto parts manufacturer that filed for bankruptcy recently. And they make, some very well-known, or maybe for those people who are familiar with auto parts, they would almost certainly recognize them. But they make Fram oil filters. They make Autolite spark plugs and stuff like this. It's basically a conglomerate that was put together over the course of many years. And it seems as if there's some shenanigans that have been going on over there. Among other things, that they were doing a lot of factoring. What's factoring? That's, when you make auto parts, you sell the parts that you make to auto parts retailers. And these things, have you ever been to an auto parts retailer and looked on the shelf and said, there's the filter I need, there's the this or the that, and you go and you pick the thing up and it's covered with dust. These things sit on the shelf for a long time. Well, that's not great for a business where they don't really get paid sometimes until those things actually sell, believe it or not. And so you factor it. What does that mean? It basically means I have these receivables, I haven't gotten them yet, so I borrow money. And it seems that there has possibly been some double dipping going on where the same receivables have been factored more than once. That's a problem. It also seems that we're not 100% sure, but what that old saying that when the tide goes out, you get to see who's swimming naked. It would seem that some of these things came to light because their circumstances were made worse by the tariffs. So maybe I'm not saying that would have been a good thing, that they could have limped along, for additional weeks, months, or years, or maybe even indefinitely. But what it does point to is that there is some stress, that there are businesses that are affected, and marginal businesses, that could be the difference between, continuing as an ongoing concern or not. The de minimis exemption, this thing is one of those things that I personally think I'm not crazy about it. Here's the situation, and that is that, the stuff that normally would get covered by the de minimis exemption is not the stuff I really care so much if we make. really cheap goods, is it critical to the United States that we manufacture those things? Is it critical to the American worker that we manufacture those things? I don't think so. Is it critical that we onshore more chip manufacturing? I do think so. Is it critical that we produce more of our rare earth elements? I do think so. Do we want to have a circumstance where we are facing stiff competition from Chinese automakers, which might be significantly subsidized by the Chinese government? So, I don't mind us competing so much with Japanese manufacturers, Korean manufacturers, European manufacturers, because many of those companies essentially live in the same kind of an atmosphere as U.S. manufacturers do. So they aren't being provided with, a significant support or boost from their local government, which could be strategic, if not necessarily favorable from an economic point of view for them locally. And the auto industry is important to us. So I'm not crazy about that authority being withdrawn. So for all of these reasons, I'm going to suggest that on balance, I think it's not positive for us. But there are companies that have been negatively affected by them, and they would potentially rebound. It's not fast enough for First Brands, but there may be others. That was a long-winded response, but there we go. James Foreman, Mike, CNBC is crowing about the rotation out of tech and broadening the market breadth. How do you see this affecting the triple Qs going into the end of the year? A Santa rally or a softening demand in prices? This is typically a good time of year seasonally for equities. I, at the moment, at least, expect that to continue. I will say, it's an interesting thing when, we have the sort of the basket of stocks that we kind of find interesting ourselves or that we might be invested in. And then I also have visibility into the performance of specific funds, maybe funds that we manage. And by doing that, you do get a much clearer picture of what's underperforming. And what is underperforming recently are a lot of the things that have generated such eye-watering and impressive returns prior. I mean, strategy is an obvious example of this. Bitcoin is not as obvious an example, but it is an example. That's because it peaked much more recently than strategy has. By the way, let's see here. So I was talking about this with somebody else today. On the strategy front, and I think some of you have probably heard me discuss this before. So we know that they've got about 641,000 Bitcoin that they hold. And that's trading probably just over 100. Yep. So let's just call it 100,000. Keeps the math easy. So that's $64 billion worth. All right. Which, by the way, is exactly where the equity is. But that's not perfect because some of the benefit of those assets accrues to things like the convertible debt. So if we look at it on this number instead, so that works out to, I'll just call it 64 billion in Bitcoin divided by, we'll call it 79.5 enterprise value. So it's trading at about, so the Bitcoin is about 80.5% of that number, which means it's trading on an enterprise value basis at about 1.25 times the value of their Bitcoin. And what did I say before? That I think it would be okay to start thinking about getting more aggressively long strategy at 1.1 times. So 1.1 times means we want to get something in the neighborhood of 70. 70.4 billion enterprise value. So that is a decline of 9 billion. So if Bitcoin is here, so just understand this is a moving target. That's a decline of approximately 14% in strategy versus the price of Bitcoin. So Bitcoin's going to float. Strategy's going to float. I think it's worth buying strategy at a premium to Bitcoin. It has some leverage to the upside. They have some flexibility. Actually, some of the benefit of the Bitcoin does accrue to equity before it goes to the convertible debt. You have to monitor the strikes on the converts to see. But I think we're getting close here. But before we move over to that, oops, what did I just do? What did I do? I think I changed the color of my little marker there, that little tool that I've been given. The problem that we have here is this, and I'm going to go to weekly. And I'm going to adjust this. I only care about the 50. Because this is now weekly, right? So as a moving average, this line is the 50-week moving average. And to me, this looks... Oh yeah, I changed the color of that by mistake. Interesting. To me, this looks like a pretty tricky and ticklish area right here. We heard Mark, I think he said, someone might refresh my memory, I think he was saying that he could see as much as a 30% decline. I don't know about that. That seems like a lot. I would imagine that there's some measure of support down here around 80,000. But there's serious risk. We can see that in prior occasions, like right here, for example, when it violated that uptrend, it went considerably lower. What is this level here? We're down around... Yeah, we got down to around 16,500 from 47. So, we're talking about it losing more than a third of its value. Anyway, let's go. Are you still bullish on Uber? Stock seems settled. Yeah, I really don't think that the circumstances have changed much here from a fundamental point of view. We kind of hit those numbers. Let's just take a look at, what you're buying. Long-term growth rate still looks reasonably solid. It's trading at a reasonable turn to next year's adjusted EPS. We're just going to throw this one, the full year number out. Very reasonable free cash flow, assuming they can hold in there, that these numbers remain true. So yes, that's the short version. Okay. Why is the NAV of ULTY dropping, and what will you do about it? Well, I'm not the only one. Let's just talk about for any fund. I don't know that it's necessary to take a look at ULTY, but I think one of the things that's important when you're evaluating the performance of funds that you're invested in, number one, do you appreciate their strategy and their approach, and do you continue to believe in both? And you will find periods of out and underperformance in almost any strategy. ULTY, because it was focusing on high implied volatility stocks, tended to get additional concentration in some areas that haven't performed very well of late, including crypto. One of the names that's in there now, we have Bitmine, Immersion. This is actually so choppy that this is probably too much to look at. Let me see if I can shorten that up a bit. And as you can see, as the market has continued higher, this one has not. Other names that are in there. Here's another one. Some of these stocks, which started off the year well enough and did exceptionally well, have not done so fantastically since. This is another one. And what's interesting to look at here is that, and again, like I said, every manager doesn't have the same approach necessarily, but we can see that it did break below the 50, and more recently it broke below the 200. This wouldn't have ended up on my screen, or if it had been, it would have been knocked off once it fell below those. But there are people who are do more involved and perhaps elegant technical analysis than I do, because I tend to focus on things like fundamentals as well. I try to keep my technical analysis very simple. If it's dropping below long-term moving averages, I just take that as a very simple, people are not putting their money into it, they're taking it out. I'm not making any kind of a fancy judgment about it beyond that. But, periods of out and underperformance in any fund are likely to exist. I will say, though, I'll give him credit. I was looking at Granny earlier today, and at one point the S&P was slightly lower and Granny was slightly higher. And I thought that was impressive. I mean, it's a one-day thing. It's anecdotal. But I did think that was interesting. 996 Capital Fund LLC. Hi, Mike. Able to find out more about Hyperscale outside the... Oh, yes. That is a question that I absolutely mentioned that I was going to look into. And, in fact, I did not get as much work done on that as I had hoped to do. In part because I got a little bit distracted by a couple other things that started capturing more of my time and attention, some of which we're going to be talking about next week, which I encourage you to tune in for on Tuesday at noon when I have Mark back for office hours. Been taking a little bit more of a look at the transports because, and by the way, somebody put into the chat when we were talking about the tragic crash of the UPS plane, and I had said that I thought 7% and 9% were the respective percentages of the freighter fleets for FedEx and UPS, respectively, that were going to be grounded. And then somebody, I think, gave us a number that was in the 4s. I looked into that, and I'm not sure where the discrepancy lies, but 6.6 was the number that I was able to identify afterwards, which is not insignificant, right? You take 6.6% of the air freighter fleet out going into the holidays. So that was on the FedEx side, 9% for UPS. This is an important implication. Now, they can go to third-party companies as well. I would assume that they had already contracted for that. But this, I think, this is one of the things that distracted me. One of the reasons I kind of set the international hyperscaler business to the side as I was looking at it. I also had the opportunity to speak with a CEO from Canada, mostly in the energy business. And what we were talking about was the suitability of Alberta for data centers. There's obviously a lot of energy there. They have cold temperatures for a significant portion of the year, which is, a potential benefit. So I can see some areas that there should be a meaningful build out. So what ended up happening as a function of your question was not only where does it exist now, but where are they intending to build it out and why? So yeah, and also in some places they have things like, we don't have it here, but there are places where carbon credits are going to play into all of this because that is an issue in some places, and they consume a lot of energy. So, carbon footprint, credits, local temperatures, accessibility to energy, all of that kind of, because cheap land is also really helpful. But yeah, there's more work to be done. I'm sorry I don't have a more concrete answer for you there. Tucker D Dog, too big to fail reminds me OpenAI was starting to try to push the narrative they were too big to fail. What? Yeah, I don't know about that. I would encourage. So there's a Frenchman who is one of the leading people, or was one of the leading people on the Meta AI team, who decided to leave, and he's going to go do his own business. And he and another researcher, I think her name is Fei Lai or something like that, at Stanford, both of them are a little bit critical of the large language models and using AI that is trained off of, for example, publicly consumable internet-related data. They think that that is not the best approach. I encourage people to take a look into that, because I would agree that, and I have seen, as many of you almost certainly have as well, that not only are large language models not infallible, they are quite fallible. I have found them making mistakes in the past, not infrequently. And, the problem is that when you have a lot of sort of garbage data out there, you're going to end up with situations where things that train on it are going to push some garbage out as well. So I actually would say that I don't know that OpenAI is too big to fail. Would be unfortunate for NVIDIA. It would be unfortunate for a lot of other companies tied to it, and that would include Broadcom, AMD. It would include Oracle, which has agreed to do deals with them. But I think that it is too soon to believe that that is the only way forward. It is the way forward that most people are paying attention to now. And the reason is because these large language models are, from the non-practitioner's point of view, examples of artificial intelligence that come closest to what I think people imagined it might look like. Something that you would interact with in a very human-like way. Whereas the important thing for AI to really help us out is that, in many respects, it needs to be superhuman and not very human-like. And so in that area, I would suggest that perhaps the large language models are, not the end-all, be-all. They are for the moment, but I don't know that that remains true. Tucker D. Dog says, I don't want Chinese-made car after UK investigating potential remote control built into Chinese-made buses they bought. Yeah, I mean, this is an interesting one. I mean, if you get into a situation where the cars can be controlled remotely, that does change things. One wonders whether that is going to be mandated at some point. So, for example, how many sort of tragic crashes have to happen in high-speed chases where somebody says, you know what, we don't want police cars doing pit maneuvers on people who are running away on the freeway at 120 miles an hour. We want a remote control that just basically says, okay, we want this thing to stop. There are those who certainly want that. There are probably plenty of people who don't want to buy cars where that's true, that the government can just basically say, nope, you're not going anywhere. That doesn't sound particularly appealing. Yeah. Or worse, yes, it's a very good point. For a Chinese car, or the Chinese government decides, you're not going to go anywhere. That's not an appealing outcome. So, in any case, we're not setting things up so that it's going to be a free for all for Chinese imported cars, because I encourage all of you to go look. But I have spoken to people who have gone there and come back and said, Chinese cars are quite remarkably good and very inexpensive compared to what we're used to paying. And that whatever people might say, oh, I don't want a Chinese truck, or I don't want a Chinese car or a Chinese sports car, that's all fine and good until you find out that the car that you were going to pay $40,000 for, that a Chinese equivalent, which is maybe very nearly as good at seemingly, is half that number. And those are the kinds of, that's the orders of magnitude that we're discussing. It's not like a 10% discount. In many instances, the products that they're selling there are meaningfully cheaper. And that goes a long way. And that also goes to this tariff conversation, which is, I have certain free market leanings, and Milton Friedman, would often say that, tariffs and anything that interferes with free trade was bad. And in general, absent malevolent actors, I would tend to agree. Workers in other countries benefit, consumers in other countries, here, there, everywhere. In theory, we benefit from freer trade. But admittedly, and here's the thing, if you brought over these cars and they were all cost 50% of what the same vehicle effectively would cost, you would see a lot of people move over to the other product. They might say they wouldn't. They would. I think that's reasonable to say. Healthcare sector seems to be doing well lately. You see that continuing until year end. This sort of goes. Why don't we take a look at this? Let's look at it this way. All right. So I'm just going to look at the healthcare ETF, XLV. And we're just going to blow this out a little bit longer. And I would say you have considerable room here. We clearly have momentum. It's doing very well today. Was it the best performing sector today? I mean, it's got to be up there. It was. And the short version is yes, right? So we like these things until we don't. What means we don't? When you see the momentum shift, what could that momentum shift potentially be? I mean, I guess the worst case that somebody could make against them at this point is that perhaps they're a little extended versus their long-term moving averages. But that's insufficient because actually they're not up really that much on the year. And therefore, it's not like the valuations have become grossly extended. So when I look at this, I can still see that the all-time highs were substantially higher. Bear in mind that you've got things in here that I don't think are ever coming back again. So you had a Moderna in there, and you had Pfizer in there at levels that were not justified then, that I don't think they're going to return to. So from that standpoint, I wouldn't get overly excited about it. But yes, I do think it has continued momentum, just like equities broadly, and this, is outperforming. So I think I have chewed up now at more than an hour and 15 minutes. An hour and 19 minutes, the clock over here is telling me, of your valuable time has been squandered listening to me yammer on about this or that once again. And for your time and attention, I really appreciate it. And I'm glad that you guys have some questions for me. That helps guide the things that we talk about. In fact, it will be whatever we talk about. So if you have any questions we didn't get to, other than the foreign hyperscaler one, which I do owe you some updates on, put your questions and comments and concerns into the comment section, and hopefully I'll have an opportunity to respond to those in a future video. Thank you very much for watching.